Hey, everybody. Welcome back to another show. It's absolutely beautiful out there this Saturday. And, I'll be getting out there pretty soon. Here's the funny thing. All right. So for home prices for the last consecutive 19 months, that will be as of December, we've had positive growth. Let's talk about that. We're going to go through February metrics. We're going to talk about where is our market going. We're going to kind of talk about what is the spring market going to bring for us? What are rates doing? How does this help you to make a really good business decision? We're going to get to it. Be right back. Okay, so a lot of folks are saying, George, man, there's a lot of mixed messages out there. I mean, some people are saying the market's good. Some people are saying the market's bad. Well, let's take a bigger look, and we're also going to take a look at a running 10-year history to give you guys a better perspective of where we're at so you can make, again, just a really good, the best business decision. All right. So Case-Shiller came out and said, hey, guys, man, national home prices have risen by 8.8% annually since 2020, led by markets in Florida, North Carolina, South Carolina, and Arizona. And when we take a look at it, it says, while the national index continues to trend above inflation, we are a few years removed from the peak home prices of 18.9 observed in 2021. And that is not an uncommon thing because remember, in 2020, when you guys were supposed to be home, we saw a massive upswing of activity. Why? Feds were buying mortgage-backed securities, made it more scarce. That raised bond values, and that means mortgage rates came down. And they kept those down. They went down as low as 2.5%, and then they started to creep back up to about 4.5%. And then in 2022, when the Fed said, we're not buying any more mortgage-backed securities. In fact, we're going to sell them. They flooded the market. Bond values dropped. Mortgage rates almost went vertical and went from basically the high fours, low fives, almost up to the eights. And then, of course, that settled back down again, and we started to see and get back down to normal rates. So it's not an uncommon thing that well, it is a very uncommon thing that happened because that will, unless the Feds buy rates down again, we're never going to see those mortgage rates that low again. However, when we talk about getting back into our normal market, that's what I meant to say. So as we kind of continue this little report, it says in Seattle, home prices posted a 5.61% year-over-year gain in December, even though they slid 0.3% month over month. And again, that's because of rates. The 10-city composite index rose 5.1% on a yearly basis and 0.5% on the monthly one, while the 20-city composite rose 4.5% annually and 0.5% monthly. Here's the thing. The Case-Shiller, they have a 20-city index that they look at, okay? Then they have a 10, and then they have a 5. So those are things that we will actually look at and we balance a national market to a local market to see what's happening on a bigger scale and how are we adjusting accordingly, since we are one of the top 5 sweet spots across the United States. All right, let's button this up. And it says, pressure on home prices remain muted as many potential buyers and sellers decided to step away from the home buying and selling activity going into the winter months. Okay, while anticipation going into the spring market home buying season is building, there's no clear sign as to if they're going to rush in as they did a couple of years ago. And that's a really good question. So here's the funny thing. On a national level, they're seeing a little bit of wane, and there's a lot of unknowns, and a lot of the big head sheds out there are, they're like, and everybody guesses until it happens. But there are some trends that we look at, trends that we can, see as to what's going on. As an example, you're going to see that we have a gaggle of new homes that came on, which bumped up our inventory levels for residential homes in the Northwest MLS. But is it situation normal? Or is it actually we're still super low? You're going to see that here shortly. Now, when we take a look at what's going on with the headlines for the week, which is going to tie into all of this, and why are we going to spend more time talking about some of these key metrics, says, look, new home sales dropped 10.5%. Again, that's nationwide. New construction, meaning new home, not new on market, but new construction. With that, home price growth, probably the last thing to worry about these days. Kind of a funny title. When we talk about and look at the inflation, we take a look at other economic factors that are coming into play right now, including, hey, is our spring market going to take off, which we're going to get into that prediction. What's going to happen? What's going to continue to happen with mortgage rates? And those are the why pricing becomes a little bit less of a concern. Moreover, hey, what the heck is going to happen with rates, inflation, and the overall market? So upper right, you can see that we're yet down again. We're down to what we would consider par pricing is 6.74, as just a couple of weeks ago, right? We were at 7.2% or 7.02, I should say. And then mortgage rates quickly moving towards a 4-month low. And super awesome. Completely consistent, and it follows the pattern in which we have stated will be happening, in which, well, it has. So I guess our predictors are still really good, and we'll continue to see the rates come down, but they're going to start to slow down. As we get closer to 6.5%, we're going to start to see things start to moderate. We had some new information that came in on Wednesday from FHFA and the price consumer index. When we talk about manufacturing costs, some of those numbers, well, they didn't fare quite as well. And I think we're going to start to see a tad bit of slowdown in the bonds, which again is where we get our mortgage interest rates, not from the feds. All right. So if we take a look at pricing and mortgages right now, we take a look at Freddie. So Freddie, as you can see right here, we're down to 6.76, a tad bit higher. It's a little bit of a lag on the other one. But we're down, basically 0.38% or a third of a percent as to where we were at just last week. And you can see how we're gradually going down. Now, as we get to the 6.5% and maybe just a shade bit under, we're going to see a lot more refinances, and we're going to see the buyers coming in. We've already started to see an influx of homes coming on market in anticipation, seasonally normal, for our spring market. So don't be shocked by some of these numbers and say, oh my gosh, we're going to go over that, and we'll just keep perspective. So when we talk about market, look at this. So the center chart here shows us there were about 52 days on market for an average sales price. 48 was last year, roughly about a 4-day increase from active to pended, okay, which is the number of days on market. And when we take a look down below, you can see that where we were at 98%, which is it's 1% lower on a list to sales price. And you might say, George, what the heck does that mean? Let's use 100, okay, 100%. So if 100%, meaning that I list a house at $100,000 and I sell it for $100,000, that's a 100% list to sales price. Right now, we're at 98%. Or if I list a home at 98,000 or at 100,000 and I sell it at 98,000, okay, that is that 2% adjustment. When we talk about year to date, that number is just a little bit lower. It hit the 97, whereas we were 98 last year. It's still a 1% adjustment. So the chart on the right, the what we call the running 7-day average, I did this one, as you can see, this is Friday's numbers, okay? So you can see on Friday, we had 823 homes that came on market, and we had 1,006 that went pending. So you can see that we still are taking off more homes than we brought on. And you might be saying, okay, George, that's all fine and dandy. Why are you saying Friday again? And why are you denoting it as such? Because I tell you that during the week, it actually has a significant change. And you're like, okay, well, what is that change? We've had that question. What is the difference? All right. So if we take Wednesday's numbers, and let's blow this up for you. So on the left is Friday, right? 823 on market, 1,006 went off market. On Wednesday, the 7-day running average was, 537 homes came on market on the average, right? And then, of course, 1,012 went pending. So you can clearly see that Friday is a massive list date for us, and that is totally common. And so that's why that number can sometimes seem a little skewed, and why you need to understand we are still taking off more homes than we're putting on. And that is, again, a very positive direction. Remember, we're going to see our seasonal inventory increase, all right? So as we take a look at our next chart here, but before we do, yes, remember, it's super accurate. You'll be able to go back and see the history. If you're looking at making a really good business decision, well, you should tune into this channel. How's that? All right, let's talk about this. So new, look at that, blue line, boom, goes way up. Our sold line, which is our pended line, which is the red line, that's doing our seasonally normal. If you take a look on the left, you can see the normal indicators of where we're at. But look at that. We kind of took a downward trend on inventory, which is super shocking. But let's get into pricing first. So when we take a look at the average list price, okay, and we take the average sold price on the chart up above, I drew a line of where we're at today in 2020-25 versus where we were at last year in 2024. And you can see that the active, which is the green line above, or the for sale, is right on target. It's right where it should be. Now, the solds, however, you can see that our sold pricing today is normal, and you can see we have that normal wave. What does that translate to? That translates to our average list price year to date is $11,000 more than it was last year, okay? Then when we take a look at, actually it's less, my arrow's going the wrong way. When we take a look at, but it's $11,000 more than it was last week. Let's put it that way. We're still down lower as far as average list price, but it's $11,000 higher than last week, to be clear. Now, when we talk about the average sold price, that is up 3.3% year to date, and it is $6,000 higher than it was last week as a average sold price. Now, that doesn't mean that, hey, my home went up, 3.3%. It's the average sales price. And as we equate each month, each quarter, we take a look at, okay, if the average sales prices are doing this, what are the mean prices doing, or the median prices doing for homes? And what is that overall appreciation looking at? And that's what we evaluate each quarter, each month, and of course at year end. When we pop this back open, when we take a look at the month of February, again, it shows we're down 1.9%. Sales for the month of February, sales price was up 2.5% and $9,000 higher than it was last week. Now, what does that translate into actual numbers? This is where the tire hits the pavement. This is what's kind of important, because as our spring market rolls in, you can see that we have a 34% increase in inventory. And you might be going, George, holy mackerel, that is a ton. And I'll be like, time out, wait. You're going to see that maybe it's not. Are we still under where we should still be? Hold on, let's get to that. When we take a look at the average number of homes pended, heck, we're up 10%. That's a big number so far to the year to date, because even sales are up 8.8%. Now, when we take a look at the February, which is the lower chart, okay, so we have 2,088 more homes on the market today than we did last year at this time. Okay, great. We're less 38 homes for the month of February. So actually we had a few less homes that came on market. Up 267 homes as that sold year over year. And for the month of February, 391 homes actually went pended over what we saw last year, or 9.3%. So you can see our numbers as far as activity is doing really well. We're not going down, we're going up. Prices are doing their adjustment, seasonally normal. And we're going to start to see, I think, a little bit more aggressive buyers, which means a few more multiple offers, which we are already seeing. And we're seeing some escalations in some areas that make you scratch your head. I just don't get. But anyway, nonetheless, there you go. All right. So if we take a look at the 10-year running average, because here's the thing, the 10-year running average is going to give you a very big picture. And that very big picture is going to give you, because we're only looking at year over year, kind of the, hey, what is normal? Okay. I've been doing this for 33 years. This chart looks very consistent, except 2020, 2021, and the first few months of 2022. Those are our one-offs. Kind of like 2008, 9, and 10. Those were one-offs the other way. In fact, absolutely bipolar, and you're going to see some of those things change. So let's open up our 10-year average sales price. We go from 2015 to 2025, and you can see we have our normal bumps. Now, you might say, what are the peaks? The peaks are summer months. Totally normal. That's when we start to see more sales. We see better pricing. And during the winter months, we tend to see lower pricing and lower sales. That's why it does this. Seasonally normal. All right. So if we open this back up, and then we take a look at number of homes for sale over the last 10 years, and I can tell you that on the left, where it says 2015, it actually continues in an upward trend. As we get to about 2007, that's when it starts to fall back off. So you can tell. Look at, and I drew a red line as to where we're at today, 2025, and you can see that we have a massive amount of shortage of inventory that is available, okay? We are probably about 60% of where we should be today. The 2020 through 2022, very obvious. And then, of course, you can see where the interest rates spiked up in 2022. When we take a look at closed sales, again, red line of where we're at today, and you can see where our sales are under, our listings are under, but yet our prices still continue in an upward trend, right? And when we take a look at this and we evaluate everything that is happening, look, we need more homes for sale, but we're at 2.5 months of inventory, which really, that's kind of our balanced market. And that's what we've been seeing over the last 10 years, that 2.5 months of inventory really is the new norm, not 4 to 6 months of inventory. And so when we consider where we're at today, we're pretty balanced, and prices and time on market is pretty consistent. Just saying, as we start to see more homes come on market, we will start to see more sales happen, which is normal, okay? It becomes more evident when we take a look at the new construction. So new construction itself, super interesting, right? Take a look at this. Our inventory, the blue line, like everything else, just fell off. I mean, literally fell off. Normally, as you can see on the left-hand side, it should have been continuing upward. Pricing, super flat, which is not uncommon. And in fact, when we take a look at the upper chart here, you can see that the number of homes that have been coming on for average price, just slight flat, slight tiny bit down, tiny, because new plats coming on market are a little bit more, or I should say are better priced than where they were a year ago, okay? Now, the prices are higher today, but we're not seeing an upward trend. We're seeing more of a flattening trend. Now, when you take a look at the red line, you can see last year where I drew the line, we're still above where we were at last year. However, we've closed out a whole bunch of plats. And so we're going to start to see some of the outlying plats have a bigger impact. As you can see, year to date, par pricing today for solds was $974,000. Whereas when we take I think I actually have a bigger chart here. Hang on. There we go. $974,000 is our average sales price today. We were at $999 last week. And then, of course, year to date last year was $916 versus $907. So again, that is situation normal. Just like we're seeing for the month of February, we saw a higher price, $974 last week, $937 was the average really at the end of the month. And then, of course, $929 versus $955. Again, absolutely situation normal as we look at year over year. And if we go to prior years, you're going to see that same thing. So it's not like new construction has taken an absolute tank. And in fact, let me show you why that case is not the case. All right. So we open this up And we were like, okay, let's take a look at actual volume, right? Let's blow these charts up. So year to date, the top chart, look at that. So right today, we're about 10.3% under year to date where we were at versus last year. But last week, we were at 15.7. So you can see we actually made up about 4.3%, 5.3%. Now, when we take a look at pended, again, the same thing. So if you go down to the chart down below, which is the February, the entire month of February, look at that. We're only under, we had 14.7 less closings. But last week we were at 27.5 month end, massive close time. And that's why you saw that. And in fact, we'll carry over part of those numbers into the first days of March today, right? So when we take a look at the actual number of pended, look at that. We were at 11.7%, 14.8% last week, but we were under 26.2% just 3 weeks ago. So in the last 3 weeks, especially in the last 2 weeks, we've seen our numbers take a significant improvement. Again, situation normal. Month end always does better than the first half. Plus, people like to close at month end because it costs you less out of your pocket as a buyer. It's cheaper. Makes sense. All right. Now, let's get to where we talk about, yes, you guessed it, REOs. REOs, again, like everything else, is actually doing really well. Inventory, yep, you guessed it, like everything else, has fallen. And the actual pendants have increased. And so when we take a look at the actual map, you can see how few. You might say, George, what does that mean? Normally, we would have about 4 times as many dots out there, those little houses. In 2008, you couldn't even see the map. There were so many foreclosures in 2008 and 9 that it was just unbelievable. And foreclosures right now are not a great investment just because we get par pricing. And I mean, when we take a look at it, look at this. These numbers are crazy, right? So year to date, we're down. We have fewer homes coming on market. Inventory is down even in February. Again, that number is down. When we take a look at actual more getting homes under contract, those have bumped up, including our sales. When we take a look at the average combined days on market, about the same, situation normal. And then, of course, when we take a look at the average sold price, remember, $100,000 market, if I sell it for $100,000, it's 100%. This is at 95%, which is, again, situation normal because they need to overprice a home. I hate to say it that way, but they do to ensure that the investor that contracts with the loan servicer is getting best price. They're not leaving dollars on the table. And that's how that happens. So if you have any questions, post it down below. But here's the funny thing. At the end of the day, the market is doing very well. We are seeing seasonal normal numbers. We are still under where we should have, even looking at the 10-year running average. And if you have any question if this is going to be a really aggressive spring market, pick that off to the side because I think it is going to be. I think we are going to see rates start to come down to 6.5%, and we're going to see some pretty aggressive activity. May, April, we might hit a little bit lower in the sixes, might hit briefly into the high fives and then bought back again. It depends on if the Feds drop rate again, which we hope they don't. They'll be meeting here shortly on their 6-week meeting. And if you have any other questions regarding that, hey, post them down below. Leave your comments. Absolutely love them. The guy who said, George, your backgrounds are worth more than my house is. Not the intent. I just like really good backgrounds. Anyway, that's it. Have a beautiful day. Smash the subscribe button, and I'll see you on the next video. Take care.